Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go here until the closing bell, and stocks are higher. That's after data showed the U.S. economy expanded at the fastest pace in 2 years. You've got the Dow up about 75 points. The S&P 500, your broad gauge, that's up about 0.4%, rising for a fourth straight day there. Your tech-heavy NASDAQ, that's up about 0.5%. Well, the delayed reading of third quarter economic growth unexpectedly surged to 4.3%, driven by consumer spending. And Jennifer Schonberger is here with more and White House reaction. Jen, over to you.
Thank you, Josh. And for more on that, I want to welcome into the program Joe Livornia, counselor to Treasury Secretary Scott Bessent. Joe, always good to see you. Thanks so much for joining me.
Thank you. Very good to be with you, Jennifer. Happy holidays.
Happy holidays to you. And what a way to kick off the holidays with such a stellar third quarter GDP number, up 4.3%, a full percentage point above expectations, and driven by consumer spending up 3.5%, though a large chunk of that from healthcare spending. Though we also saw trade really add to this number as well. Joe, can we see this level of growth sustained into next year?
Yes. Let me say this. You mentioned the consumer, talk about healthcare. Healthcare was up a lot, yes. However, consumer goods, spending in real terms up over 3%. Recreation up around 7%. Transportation up, I also believe, around 7%. You had a big gain in other consumer spending services. So the gains are very broad-based. That dovetails with all the anecdotes post the holiday shopping season, Black Friday, et cetera, that show huge spending. And let's not forget CapEx, which grew over 5%, and the fact that exports were up nearly 8%, and the trade deficit, thanks to President Trump's policies, are shrinking massively. What we have, Jennifer, right now in the fourth quarter potentially is an economy that's growing at 3%, according to the widely followed Atlanta Fed. If that number is correct, that will put us at just a smidgen under 3% for the year, which is remarkable. So we could definitely do 3% type GDP growth, maybe more. We saw that in the first Trump term, and these data were a 10 out of 10 this morning.
To your point, Joe, on the business investment, we saw that slow a bit to 2.8%, and ordinarily that would have been really strong. Of course, that's coming off, 7% from the prior quarter. But also with all of this AI data center build out, something that caught my eye was that investment in non-residential structures contracted at a 6.3% pace. What do you think was going on there? Is this sort of an ebb and flow, an anomaly here? Should we be reading into this at all?
I'm happy you mentioned that, because the number that I cited was for equipment spending and software spending. That was over 5%. On the structures, that's very weak. Some of that could be due to just waiting to see what the guidelines look like for the full expensing of factories, which is part of the one big beautiful bill the president got done in record time. Data centers are not part of that. People are overestimating the AI effect on the GDP numbers because a lot of the spending is business to business, which is actually not part of GDP. But if you're asking me why I think structures are so soft, it's the same reason why residential investment, which was also negative in today's report, was soft. It's because interest rates are too high. Yes, the economy is booming, but this is a disinflationary boom, a disinflationary CapEx boom tied to President Trump's supply side pro-growth deregulatory policies, and therefore interest rates need to come down. If interest rates come down with the expensing we've got for the factories, we will build a whole lot more next year, Jennifer. That'll be high-paying construction jobs. All the capital that will go into those new buildings, that will be fully expensed. And of course, the workers that will be there, because manufacturing pays higher than average wage rates, will have really nice incomes, really fat paychecks.
Yeah, I want to come back to that point on jobs, but you brought up the lower interest rates, Joe, and we saw the stock market wavering a bit earlier today because they thought, strong GDP means no Fed rate cuts next year. And we saw the president acknowledge that in a post on Truth Social. And he says, look, anyone who tries to basically stagger this rally by raising rates or holding rates steady, I don't want them as my Fed chair. You think the Fed can continue to lower rates next year if the economy sustains a 3% growth pace?
Yes, because if the economy is growing at 3% because potential supply is increasing, that means lower inflation, and the Fed could accommodate that because if real rates are rising as inflation is falling, monetary policy is actually getting tighter. Right now, Jennifer, the yield curve is still very flat, meaning when you have easy money, the yield curve is steep. There's a big spread between long and short rates. That's not the case. The dollar would be a lot weaker. That's not the case. In real broad-weighted terms, the dollar is extremely high, and inflation expectations are incredibly well contained. They're basically predicting 2% inflation, which is price stability. So the Fed can continue to lower rates. The Fed should lower rates based on its own estimates of where R star is, the neutral rate, and based on the fact that interest-sensitive activity is still extraordinarily weak, and that's where monetary policy has the most impact, are those interest-sensitive sectors.
With such a strong print on the economy, why do you think we've seen a softer job market? Typically, we have not seen that. Some people have suggested there is a decoupling now between GDP and employment. I sort of scratched my head on that one. Do you think this is sort of temporary? And to your point, maybe this is, I don't know if it's uncertainty or whatnot, but we could see a resurgence in hiring next year. Oh, go ahead.
Sure. It's temporary, Jennifer, because there are lags. The economy recovers and it takes a little bit of time. It doesn't happen instantaneous where you get the jobs. What we saw over the prior 4 years under the prior administration was record government spending, which effectively gave the economy a sugar high and boosted the labor market. What we know after the fact with revisions, jobs have been revised down nearly 2 million workers in the 2 years prior to President Trump taking office. So the labor market was massively weakening. Given the private sector gains we're seeing in GDP, which, by the way, no one I see has talked about this, if we take the government out of the GDP accounts, the last 2 quarters have seen annualized real GDP of 4.7% growth. That will lead to hiring, and it will lead to high-paying jobs that will accompany that fast acceleration. So the jobs will come. We have seen the 3-month moving average on private employment go higher. My expectation is based on the numbers we're seeing, the pro-growth policies, which haven't even really affected the economy in a full capacity yet, will lead those employers to hire. And this puzzle, as you said, between the strong GDP and low hiring will come together with employment rising to the GDP.
And to your point, before I let you go, we've got this strong GDP number. You've painted a strong picture ahead. Yet the consumer sentiment number out this morning for December showed that consumers have soured to a level that we haven't seen since April. A lot of people feel like things are very expensive now, but if we were to see more job growth, higher wages, as you have painted, would that not help the affordability issue? Do Americans need to be, for lack of a better way of putting it, a little more patient here, perhaps, until the middle of next year?
American families have suffered mightily over the past 4 years. Living standards collapsed under the prior administration. And yes, it will take time, but the good news is that the policies the president has put in place, in particular the no tax on tips and overtime, will significantly raise after-tax wages next year. We've seen, Jennifer, through November, real blue-collar wages, which is in the establishment data, as it's known, I'm getting wonky, the non-production supervisory workers up 1.6 year to date. That's one of the biggest increases in 60 years to start a new administration. So we just want patience just because things are getting better. But we understand people's frustrations. The confidence numbers are weak. Partly, I think that reflects maybe bad polling. I would say it matters more what people are doing than what they're saying. But if the economy continues to evolve, and we've been saying this for a while, the secretary has been very clear, 3% growth this year was very doable. When nobody thought that was the case, then people are going to be very happy as we get into 26 and beyond. And a lot of these numbers will also improve.
It is true. We've heard a lot of belly aching, but still people are opening up their pocketbooks. We'll have to leave the conversation there. But Joe, thanks so much to you as always for your insights. So appreciate it. Happy holidays. Look forward to seeing you in the new year. That's Joe Livornia, counselor to Treasury Secretary Scott Bessent. Josh?
Great stuff as always. Thank you, Jen. Well, as Wall Street gets its first look at third quarter economic growth, markets wobble on trimmed hopes of near-term interest rate cuts. But our next guest lays out why the scales are tipped, he says, in favor of a more optimistic outlook for markets in 2026. The Wealth Consulting Group Chief Market Strategist, that would be Talley Léger, joins us now. Talley, always great to see you, especially on set. Let's get right to this target of yours for 2026, Talley. You say we're going to move here to 8,500 next year. What gives you the confidence to make that call?
Josh, we bury the lead with our target for next year. But I think what our peers underappreciate is this market has been on a higher technical trajectory since 2022. And all the stock market has to do is oscillate around that pre-existing trend to get us to 85. And it's supported mostly by good old-fashioned earnings growth.
So on that move to 8,500, I'm sure clients ask you, okay, what could derail that move? What do you tell them?
So we fully expect our enthusiasm to be challenged next year. That's just something that happens. It happened this year. It's probably going to happen again. Top of mind on that list of headwinds, which we do prepare clients and advisors for, could be global central bank rate hikes, perhaps from Japan, and a global carry trade unwind. But if we're right about the fundamentals, that kind of volatility could present a buying opportunity for investors.
That's it. So if let's say, who knows what pops up next year? There's a growth scare, there's a credit issue, some geopolitical event nobody saw coming. If that happened, you would say, okay, that's a buying opportunity, Talley.
Right, because we've got $7.5 trillion of cash on the sidelines that could be recycled back into markets and support asset prices. And we are always looking for opportunities to buy and position and increase allocations.
All that cash on the sidelines you referenced there, Talley, what gets that cash moving into stocks and bonds? What could be the catalyst?
Great question. So we all learned preferred habitat theory in finance. And as our central bank, the Federal Reserve, keeps lowering those interest rates, the policy rate, it actually makes cash less and less attractive and kind of pushes investors out of that safe haven. It's also a great tailwind for multiples. So we are seeing a little bit of a tailwind from cooler than expected inflation and lower interest rates.
Apollo's Torsten Stock, smart guy, Talley, he told his clients something. This got some attention. I want to get your take. Torsten told his clients long-term interest rates, he says, are going to stay higher for longer, and investors should plan accordingly. You agree with that? Higher for longer?
So I'm a fan, but I don't always draw the same conclusions as he does. I think he's really making a global statement, and we did talk about that earlier in this segment, but I think that there is scope here at home for the Fed to keep lowering the federal funds rate because we're still a full percentage point above the headline CPI rate of inflation. So that means policy is still a little bit restrictive.
On that debate, of course, with the Fed, the cycle continues here. Who could be the next Fed head? And you've seen these reports, Talley, that maybe a decision is going to be announced pretty soon, actually, early next year. Waller, Warsh, Hassett, Reader, maybe your dark horse. Any, I'm sure clients are asking about that. Do you have a preference there, Talley? Do you think the markets have a preference?
Well, I'm not an insider on the composition of the FOMC. I do think that Hassett seems to be in the lead right now. But one thing's for sure, that the president does have the ability to stack the deck in his favor. Until everyone's in their seats, he can kind of orchestrate the composition of the FOMC and engineer a slightly dovish tilt to policy. Beyond that, once they're in their seats, they're an independent organization. But for the reason that I gave, I would be in the camp that was expecting the Fed funds rate to keep coming down. So we're closely aligned with the prevailing rate of inflation.
What's your take on the American consumer right now, Talley? We do hear a lot. There's affordability issues. There's economic anxiety. But then we try to square sentiment with hard data. Q3 GDP print you got today. You saw this under the hood here. Household consumption jumped 3.5%. What's your take?
Breaking records with the holiday sales. What's going to happen next year? Well, I think it's really the higher end asset owning consumer that's really going to keep the boat aloft here. And again, some of that, if not a lot of that cash, is supporting consumption and investment back into markets. So it's kind of a virtuous self-reinforcing cycle.
The AI trade, there was a story, there's kind of this narrative out there, Talley, that said, well, you better hope that AI trend and trade keeps going, because if it comes off its wheels, we got a problem for the broader market. But now you've seen some AI heavy names. I mean, you look at NVIDIA, well off that 52-week high. Same goes for Broadcom, for example, and yet we keep churning higher. I'm just curious to get your take on that.
So when you look at sales across all the sectors of the market, there's 11 sectors that we look at. All of them are in positive territory. So this is broad-based fundamentals we're talking about. And on the margin side, while tech is high, tech margins are close to 30%, it's actually the real estate sector that has the highest margins. So we like to say that innovation is powering a broader market. So it's the tech-enabled companies, and there's a lot across all the sectors. Pretty much every sector now has at least some exposure to technology, and at least a little bit. I think is really driving this catch-up phase for the rest of the market, and we're seeing it in performance as well, especially with the small caps.
Let me ask you, I'll get you on this. Next year, what sectors do I want to be overweight, Talley? Where's the opportunity?
So I think technology is still a good place to be because of the fundamentals, including sales, margins, and powerful earnings growth. But I also like other cyclicals of the market, like consumer discretionary. We talked about the positive fundamentals there. And some of the older economy sectors that stand to benefit, like industrials, for the same reasons, we feel.
You want to say U.S. focused, by the way, or do you see opportunity overseas?
So if you are concerned, and that's valid, about these lofty valuations, despite the tailwinds that we lay out, if you're looking for better valuations, I think small caps are top of mind, and international as well, because they've got the benefit of a weaker dollar, better value, and some flows here, I think.
Talley, always great to see you. Thank you, sir. Appreciate it. Coming up, what's next for U.S.-China tensions and how to invest amid that backdrop. Tensions with China remain high, but even with uncertainty, markets in both the U.S. and China have run higher, but the outlook more mixed. Joining me now is Brendan Ahern, CraneShares Chief Investment Officer. Brendan, always great to see you. Maybe we'll start at a high level, Brendan. You think about that U.S.-China relationship. I'm curious, Brendan, as we now roll into this new year, into 2026, over the next 12 months, Brendan, how do you see that relationship evolving, Brendan, and what do you think it means for the Chinese economy, Chinese equities?
Yeah, I think first and foremost, happy holidays, Josh. Thanks for the opportunity. I think 1.4 billion people in China wake up every day not thinking about the United States. They're waking up thinking about China's economy, and I think they're going to take the lead off. We've got the draft of the 15th five-year plan was released in October, really emphasizes domestic consumption and technology self-reliance. That's been followed by the Central Economic Work Conference, as well as more recently, President Xi released an article in a magazine talking about domestic consumption. So we as investors, we know, similar to investors in China, that's the two areas we really want to be focused on in 2026, domestic consumption and technology.
Let me ask you about the K-Web, Brendan. So we're up around 20% this year. How would you generally characterize valuations here?
So the K-Web companies are really offshore Chinese. So these are Chinese technology companies listed in Hong Kong. Those companies are very, very undervalued relative to their U.S. counterparts. These are companies like Alibaba, Tencent, JD, Meituan, Trip.com, et cetera. So we still think there's a real value opportunity in these technology companies listed in Hong Kong. That is going to be somewhat dependent upon foreign investor flow, something that we've seen start to percolate in 2025, which we think will continue next year. Based on some of the things you've been talking about, weaker dollar, that's kind of forcing some foreign investors out of U.S. equities potentially into growth stocks listed in Hong Kong like we hold in K-Web.
Brendan, there was this new report in the Journal. I want your take on it. I don't know if you saw this one. I'll read you the headline. It said, China's sprint for tech dominance can't hide an economy full of holes. The article is about how China is closing the gap with the U.S. for global tech dominance, Brennan. But the journal goes on to say here, big parts of its economy are a mess. Their words. Curious just to get your take on that, Brennan. Does that kind of align with your view?
Not necessarily. I mean, I think no one's going to say that it's all rainbows and unicorns in China today. At the same time, they're growing at 5% GDP growth, so it's not all bad either. As well as I think, Josh, if you think about this narrative that China's going to fall off a cliff, I mean, how long have we been hearing that? I mean, how long have we heard China's about to invade Taiwan? I mean, Taiwan, it's been 76 years. That's 27,740 days China's not invaded Taiwan. So I think at some point, investors need to become a little skeptical about some of this always negative media reports and basically look to resources more data-driven like we tried to provide here at Crane Shares.
Would you expect next year, Brendan, do you think that the CCP, would you expect Chinese authorities to offer and inject more stimulus into that Chinese economy next year?
I think we'll continue to see targeted stimulus. We're not expecting any bazooka-style stimulus like we saw arguably in September of 2024. But I think you're going to continue to see support for around domestic consumption. They do a lot of subsidies. They obviously want to avert a housing crisis, so a lot of attention played there. But then I also do think maybe a little bit of a sleeper is, could we actually see better U.S.-China relations with a Trump-Xi summit coming in April, as well as the APEC conference is actually going to be in China in the fall of next year. So you arguably have multiple opportunities for Trump and Xi to meet. And I just really believe that maybe the market underestimates the potential for better U.S.-China relations.
Why, Brennan, speaking of U.S.-China relations, why do you think Trump decided, you know what, he's going to allow NVIDIA to export those H200 chips to China? I mean, was it because, okay, Uncle Sam's going to get a taste, Brennan? Is it because Trump thinks, hey, for now at least, Xi has leverage when it comes to rare earths? What's the reasoning there, do you think?
I think President Trump, he's not a career politician. He's been a business person. And I think he looks to corporate leaders as almost like a shadow cabinet, where I think he wants to meet and hear the views of, if it's Tim Cook or Jensen Huang or other corporate leaders. As we've seen earlier this year, that after the CEOs of Walmart and Target and Home Depot met with him, the tariffs were kind of de-escalated. So I think President Trump is unique in that he does listen to corporate leaders, and I think Jensen Huang, arguably said, this is really, really critical for NVIDIA. But at the same time, I also think Chinese companies want NVIDIA chips. So why would you turn your back on that revenue opportunity?
Well, and here, Brennan, on this great AI race, AI hardware, AI software, who, in your opinion, Brennan, still is in pole position, still is in the lead? Is it the U.S., and if so, how long do you think?
I mean, certainly, using NVIDIA as NVIDIA is very, very far ahead of its Chinese equivalents. So I don't think there's any catch up on a Blackwell-like chip coming from a Chinese competitor anytime in the near future. I think the two countries, and really ultimately the underlying companies, are looking at AI very differently. In the U.S., it's really about an enterprise sale from Anthropic or OpenAI, really. In China, the large language models, those are open source. They're literally basically free. There's no moat to a lot of these large language models in China. Where the revenue is coming in is going to be on the cloud computing, and that's where Alibaba, Tencent, and Baidu really are going to be the main beneficiaries of AI via cloud computing.
Brendan, always great to have you on the show. Merry Christmas.
Yeah, likewise, Josh. Thank you so much.
Coming up, closing bell on Wall Street, the S&P 500 on track here to close at a new record high. We'll be right back. Hello and welcome to Market Domination Overtime. The major U.S. gauges notch another day of gains here. Just looking at the popular averages, the Dow's up about 80 points. The S&P 500 up about 0.5% to 6909. So that is a record close there for your broad gauge. The tech-heavy NASDAQ up about 0.6%. Meanwhile, investors are looking ahead to prospects of a Santa Claus rally, but investors may also want to exercise caution. Verdant's Capital Advisors CIO, Megan Horniman, joining us here with more. Megan, it is always great to see you. So listen, a good 2025, Megan, as we roll into 2026. Curious to get your take on the markets, where you stand, and what are some perhaps underappreciated risks, Megan, you think, for investors?
I think the biggest underappreciated risk right now comes around the Federal Reserve and interest rates. So we've moved into the side that we don't think the Fed's going to be able to cut interest rates at all anymore. In fact, we think there's more of a chance of a rate hike before we see another cut. That has everything to do with what we've seen out of the GDP numbers today. The labor market is weakening, so that insurance cut that they just gave us, that was a good move on the Fed's part, but we just don't think that they have the ability or flexibility to cut rates anymore next year. The growth trajectory should be okay. And what we've seen is that while inflation may have some impact with what we've seen on the productivity increase, there still is a stubborn inflation pressures. And you see that within some of the numbers here that we saw this morning. So what we've been telling investors is, have some dry powder when you go into 2026. It has been an impressive rally the past 2 years, but have some money to be able to put to work. The areas of the market that have been unloved, so when you look at value over growth, or look at small and mid cap stocks over large cap stocks, these stocks have done okay, but they're still so much more attractively priced than that large cap growth side of the market. We think that you will see some more rotation as you go into 2026 as the economy continues to have solid growth. Recession's really not on the cards. That should help those areas, and it should also help that rotation out of those momentum-driven stocks that have led us into this rally.
Megan, the counter you'll hear from some folks about the Fed is they are banking on cuts. In part, they say, listen, they don't know who Trump is going to pick. It's Warsh or Waller, Hassett, maybe it's your dark horse, Reader. Their point, though, is whoever he does select is going to have a cutting bias. What do you say to that?
They can have a cutting bias, but their job is to get some consensus in the committee. And when you look at the members that are coming in to be voting members next year, these are all hawks. So the committee actually leans more hawkish. If you look at some of the context from speeches that some of the governors or even these voting members have made, they're more concerned about inflation. They all would have suggested that, hey, maybe we should pause at this last meeting. I'm not saying that the cut wasn't the right thing to do, just to give that one more cut before we go into next year. But the chairman, even if they have a bias, dovish or hawkish, their job is to get the entire committee together in a consensus. If you continue to have a divided Fed, which it looks like you will, given the nominations that have been put forth by or mentioned by the Trump administration, then the markets can still react to that because they don't want to see a divisive Fed. They want a Fed that's consistent and all comes together. We don't think you're going to get that next year.
Let me ask you, Megan, as you look at 2026, what do you think earnings growth looks like?
I think right now the expectation of somewhere between 10 and 15% is pretty aggressive. I think high single digits is something that we could see. We've gotten a lot of this earnings growth coming out. I think you'll see some more of diversification in that earnings growth. So maybe not just that large cap growth. Some of these areas that have, earnings growth has struggled. Look at, small caps, for example. These are areas of the market that we think actually can get some relief next year and see some pretty decent earnings growth.
What about internationally, Megan? Do I want to look overseas or should I stay U.S. focused?
No, absolutely look overseas, because one of the main things that we are able to put behind us after this year is the tariff uncertainty. So now the global trade, we can kind of have a guide map here of what we'll see for next year. Some of these economies are getting inflation under control. I do think that there's some opportunity in the developed international. They're still relatively cheap on a historical basis compared to the U.S., specifically the S&P 500. So you want to make sure you have some exposure overseas as well. well.
What about, Megan, we've been talking stocks here, but what do you make of the moves we're seeing in the metals, and specifically gold and silver? You see them here, they're rallying to fresh all-time highs. What do you chalk that up to? Is that Fed cuts, momentum trade? How do you explain it?
I think there's a lot of factors. You mentioned momentum trade has a lot to do with it. Fed cuts is another one. The tariff, the complete uprooting of the global trade system, that really sparked this as well. There is a concern about debt globally. So it's not just a U.S. problem. I mean, you're seeing this in some interest rates in other areas of the world. There is a concern just about debt. So obviously in that situation, people will migrate to things like metals. But I also think it's taken over such more of a momentum trade, and people are chasing this, that I just don't feel comfortable chasing that into 2026, because I do think momentum in general, whether that's momentum in stocks, whether that's momentum in credit, whether that's momentum in metals, I think that this has gotten a little far, and I think you might see some room for contraction or pullbacks here.
Megan, great to have you on the show. Merry Christmas.
Thank you. Merry Christmas.
The private credit market has been sparking concerns, investor anxiety simmering as a number of business development companies have stumbled this year. Yahoo Finance's Jared Blickery takes a closer look in the latest installment of Stocks in Translation.
We just got a couple of nasty credit scares on the tape. JP Morgan CEO Jamie Dimon is calling them cockroaches. If you see one, there are probably more hiding. So investors are asking a very simple question. With the Fed still in cutting mode, are we heading into a safer environment for stocks or into a new round of credit trouble? BofA's Savita Subramanian looks at the data and says we might be due for a credit cycle, not in 2008 or not like 2008, but a phase where borrowers get squeezed and lenders, they get pickier. So the top gun question of the day that we're answering on Stocks in Translation, as we fly into 2026, is the air still clear, or are we quietly entering the credit danger zone? Let's start with what a credit cycle even is. It's simply the rise and the fall of available credit in the economy, specifically in bonds and loans that companies use to borrow. When money is easy, everyone gets a loan. And when money tightens, only the strongest borrowers make the cut. If you've ever seen your credit card limit go up in the good times and then get cut back, you have lived a mini credit cycle. Now to the big questions for stocks. This Foursquare shows how stocks have historically responded to different Fed and credit backdrops. When many of us hear that the Fed is cutting rates, they think green light. But BofA reminds us that if the Fed is playing catch up and the economy is actually heading into trouble, the worst box for equity is the bottom right one. That's when the Fed is cutting while the credit is tightening, the real danger zone. And that's when growth is slowing. That's when lenders are pulling back at the same time, even as rates are falling. So earnings get squeezed and investors start hitting the sell button. The open question for 2026 is whether we have drifted into that box. So what makes this potential credit cycle different from the global financial crisis? Well, back in the GFC, the problem sat inside bank loans and housing. Today, the risk has shifted to private lenders and shadow credit. Instead of housing and banks at the center, BofA flags growth, media, and cable borrowers as the new hotspots. And whereas public bond loan markets were the story last time, this time around, private credit markets are seeing higher default rates than traditional high yield. So where are we right now on the stress meter? This blue line right here is our stress barometer. It's the price of a 10-year Treasury ETF, IEF, divided by the junk bond ETF, HYG, and this is going back to 2018. Think of it very roughly as a VIX for corporate credit. When the line spikes, investors are dumping risky corporate bonds and hiding in treasuries, the danger zone. When it drifts lower, credit is generally easier. And that big spike in the middle shows what happened in the early pandemic when credit market froze, right here. But if you look where we are at the far right of the chart, we're actually off of the 2025 lows, but still pretty muted versus history. The biggest spike in 2025 is the post-Liberation Day risk-off moment. But those two cockroaches Jamie Dimon was talking about didn't register much, so it's quite possible they were just one-offs as opposed to warnings of systemic risk. So what belongs on a credit danger zone watch list? First, watch high yield bonds versus treasuries. Are investors still willing to own risky corporate debt, or are they running back into the arms of Uncle Sam? Then keep an eye on regional bank stocks. ticker Caret KRX. These are the lenders to small businesses and also local real estate. If they start rolling over while the Fed is cutting, that is a red flag. And watch headlines for media and cable debt troubles, That's one of Savita's new risk areas, and it's where streaming battles and cord cutting meet higher interest costs. Then, are weaker companies still able to refinance and roll their debt? Cracks show up in smaller, weaker companies first. And then finally, don't forget Main Street credit stress. Watch consumer credit card auto loan delinquencies and households. If they start falling behind in a big way, guess what? Jamie Dimon's cockroaches move from the private credit basement into the living room. Bottom line, we're nowhere near pandemic territory and much less of the global financial crisis. That's in the rearview mirror. But investors will be on alert for that danger zone as 2026 develops. And tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Coming up, what the outlook for manufacturing looks like in 2026. We've got a deep dive on the trends to watch, especially AI and how it will affect the industry. Now time for some of today's trending tickers. Going to start here with ServiceNow. That company is set to acquire cybersecurity startup Armis. It is a $7.75 billion deal, an all-cash transaction that ServiceNow said it will finance with both cash on hand and debt. This would mark the largest acquisition to date for the cloud software maker. The acquisition is intended to broaden its cybersecurity offering in its cloud products. Checking in on commodities as well, gold and silver continue to set new highs, standing out as the trades of the year. The rally in the precious metals space has come as investor focus in 2025 has spread across nearly every risk asset. The price of silver has more than doubled since January, fueled by strong industrial demand and physical shortages. Both gold and silver are on track to deliver their largest annual gains since 1979. And last but not least, Novo Nordisk wins U.S. approval for its weight loss pill. The green light for the oral drug of Wegovy, given shares of the Danish drug maker a boost. The company plans for the first highly effective oral treatment to go straight to self-pay channels in early January. Novo planning to launch the Wegovy pill on multiple channels, including retail pharmacies such as CVS and Walmart. This comes as the company faces intensifying competition in the weight loss drug market. Well, 2025 turned out to be quite the milestone year for Apple, and despite some turbulence, the tech giant has set itself up for its biggest change in years. Yahoo Finance's Dan Howley joins us now with news. Dan.
That's right, Josh. This was a huge year for Apple. Not only did they post record revenue, they sold their newest iPhone, seeing huge numbers as far as sales go so far. And oh yeah, they hit a $4 trillion market cap, the only other company to do that, NVIDIA. And they're, kind of playing a little closer to NVIDIA now than when NVIDIA was at $5 trillion. But what's a trillion between friends, really? Some of the things that the company did, though, really didn't have to do with one of the biggest issues that they have, AI. That seems to be pushed off until next year. They did have their head of AI retire. They're bringing in more folks. They did see a number of other C-suite retirements, whether that was their legal counsel or their head of government affairs. And it seems as though, for the most part, what this is doing, as far as the year goes, is teeing up for a post-Tim Cook Apple. Now, there was that Financial Times report a month ago, basically saying that Cook was ready to retire sometime in early 2026. Then Bloomberg's Mark Gurman said that's not exactly the case. Regardless, he is approaching retirement age. And so the company is clearly thinking about what that would look like. And so they've reportedly been grooming John Turnus, one of their VPs of hardware engineering, to be the next CEO. He's the top contender. Doesn't necessarily mean he will absolutely be the next CEO, but he's being kind of groomed for that position. And really, Apple kind of giving us a sense of, this is going to be a transitional era, and this is how we're going to handle it, kind of piecemeal. As people kind of take off, we'll fill in those slots, but it won't be kind of all at once approach. And for a company like Apple that's remarkably stable despite being so large, it can feel a little odd seeing so many departures at once or throughout the year. But the experts that I spoke to say this is really the best course of action for this company.
Let me ask you, Dan, Apple's engine's still the iPhone. In 2026, what do you think innovation is going to look like there? What could we expect? Is it form factor changes? Is it foldables or revamped Siri? What do you think next year Tim Cook has to introduce to keep that engine humming?
Yeah, I mean, the big rumor is that there'll be a foldable iPhone for 2026, and kind of the iPhone Air was seen as kind of teeing that up, showing off that they can put the goods inside of a smaller package. There's been different reports saying that the Air hasn't sold as well as, the Pro or the Pro Max or the base 17, which is a remarkably good phone for the price. But it appears as though that is what the Air was, kind of an appetizer almost, and the foldable will be the main course. Now, there's been obviously Samsung with their own foldable phones over time. They have their Fold 7, which is an incredible phone for what you get. It is priced relatively high, and you can imagine that a foldable iPhone would probably have the same kind of price premium. So, for the iPhone itself, that's kind of what we're looking for in 2026.
Dan, great to have you as always. Thank you, sir. Well, 2025 has been a challenging year for the manufacturing sector. The biggest stress point has been around trade and tariff uncertainty, but there may be signs of hope for 2026. Joining me now, we've got Tim Gauss, Deloitte Smart Manufacturing Business Leader. Tim, it is good to see you. Maybe start here, Tim. American manufacturing in 2026, Tim. If you're going to compare and contrast that to 2025, what do you think, Tim? What's your forecast? Better, worse, the same? And what are the variables that's going to depend on?
Yeah, I'm going to go with better. I think we had a challenging 2025 with the uncertainty we saw from some of the political and economic issues we all faced. But if you look at that stabilizing, a lot more certainty. Certainty is great for manufacturing. And I also see a new wave of productivity coming with the real, I'd say, growth of AI in the shop floor. So I'm bullish on manufacturing for 2026. If
you think about, Tim, Trump, trade deals, and tariffs, bottom line, as someone who thinks a lot about the manufacturing sector, are they, in your opinion, Tim, are they helping or hurting that manufacturing sector? What are the puts and takes?
I mean, there's always puts and takes in this world. I think that the outcome there is still to be determined. The one thing I can say, though, is uncertainty is what is the hardest thing for us to face. And so if you just get some certainty, get some of these things locked in, manufacturing can react to whatever situation is placed in front of it. We just need to know what we're shooting after. So overall, I'd say we're still in an evolving situation, but if we get some certainty, we're going to be off to the races.
We talk a lot about, Tim, about smart manufacturing, right? And how we want more smart manufacturing here in the States. Can you help us explain, when we talk about smart manufacturing, Tim, in layman's terms, what are we referring to? Is AI, automation, sensors? Can you walk us through it?
Yeah, I'd say it's all of the above. What I would say is really the redefinition of the relationship we have between the human, the assets, and the outcomes we're all driving together. If I think about the biggest driver of smart manufacturing, which, by the way, we're seeing over 20% of budgets going towards this smart concept, is really reshaping how we enable our people to be more effective. Honestly, one of the biggest challenges in manufacturing and all operations is getting enough people to do the job. We are projecting millions of job shortfall already, and it's only getting worse. So I see a lot of investment going towards bringing intelligence, both to the decisions we make, to the assets themselves, so we can reduce the reliance on a workforce that's already starting to age out, and actually increase the way we are able to deliver and how attractive it is to be working in a manufacturing setting going forward.
Can I ask you, when we talk about smart manufacturing, what does smart manufacturing ultimately mean, Tim, for the consumer? Does that ultimately mean, is that cheaper products for Josh? Is it faster delivery? What are the ripple effects there?
Yeah, I mean, it's all of the above. You're going to get cheaper products. You're going to be able to find them produced closer to where you are, as opposed to getting shipped all over the world, because you can make it more cost effectively in a smaller space. It's also going to give you a lot more of that feedback loop back to the manufacturer, so you get a better product as well. If you think about the relationship between product engineering to the product execution, that's becoming one seamless thread of digital flow and information. And that can extend all the way up to the consumer themselves. So if you think about how you and I are going to buy something tomorrow, one is going to be better designed for us specifically, and two is going to be probably a more cost-effective point for us too.
You know, in your report, Tim, you also talk a lot about AI and specifically agentic AI. Can you walk us through what do we mean when we talk about agentic AI, and how, Tim, are there examples where that technology is already being leveraged in American factories?
Yes, there is. So agentic AI, in my view, is how do you take, AI has always been in the manufacturing setting. We started doing machine learning, a long time ago, but this next wave is actually quite interesting. We had a lot of experimentation with kind of the Gen AI chatbot thing last year. What this is really saying is taking some of that intelligence, almost making an intelligent workflow. I would say that's an oversimplification, but actually allowing AIs to drive decisions on your behalf without having the human always in the loop. Now, I'd say manufacturers are moving cautiously in that direction. Most of the agents we see working today are assisting humans as opposed to replacing humans, and I expect that to be the situation for the foreseeable future. But a very quick example, I can tell you, if an asset breaks today, there's an agent who's already monitoring that asset, the sensors on that piece of equipment. That agent's already recommending the way to fix that. The agent is actually probably executing that work order instruction to the maintenance technician and actually monitoring for the work to get done so it can report back. So you have a lot of efficiency that's coming, and the agents are already in use in the manufacturing environment.
You hinted at this, Tim, but I just want to drill down into it for a second, because there are these questions, concerns about AI taking jobs. Is your research indicating that in the manufacturing sector?
No. In this case here, we don't have enough people to do the jobs we have today. So I always see AI absolutely enhancing the effectiveness of the jobs and helping make it more achievable for us to fill that gap that we already have. Now, will AI over time start to do different things? Absolutely. But for most jobs we see, it's going to be human in the loop and an assist as opposed to a replace. Quite frankly, I think that's one of the most exciting parts about this, because if you think about our needs to make our own stuff, it's really hard to do if you don't have the people who want to be in the shop floor. And now we're going to get that to be a much more interesting place for them to be.
I'll get you out of here on this, Tim. Let's say I'm a younger viewer. I'm watching this right now, and I'm thinking, I'm thinking about a career in manufacturing. As someone who spends a lot of time thinking about this industry, where it is and where it's headed, Tim, what are the skills you think I would need to learn so that I would be competitive, 5 years from now, 10 years from now?
Yeah, so we still have a bunch of engineers who are in the manufacturing space. I think that's going to hold true. That ability to solve problems, get to a root cause, and actually figure things out is core to us being effective. AI is going to be another tool in the toolkit, so you got a lot of fun tools to play with. But to me, it's still a good, solid engineering style education and ability to get down to the problems that you need to solve.
Tim, great to see you. Thank you for your time today. Appreciate it.
Appreciate it. Thanks so much. Have a good one.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow, but at 12 p.m. Eastern Time. Markets closing early at 1 p.m. for Christmas Eve.